Gold hit $5,419 on March 2nd, then dropped $282 in 24 hours, then climbed back, 3 violent swings in 72 hours, and most retail investors have no idea why any of it happened. What they are missing could cost them everything they made in the last 2 years. Welcome to Capital Anchor. I break down what is actually happening in markets while mainstream media keeps you focused on the noise. If you are new here, subscribe right now because what I am about to show you is not the story anyone else is telling about gold right now. Let's start with what happened. On the last weekend of February 2026, the United States and Israel launched major military strikes on Iran. The killing of Supreme Leader Ayatollah Ali Khamenei sent shockwaves through every market on the planet. By Monday, March 2nd, spot gold had surged to $5,419 per ounce, its highest level in over 4 weeks. U.S. gold futures climbed 2.9% to $5,397. Iran closed the Strait of Hormuz. That single move threatened roughly 20% of the world's daily oil supply. The Dow slid more than 700 points, oil surged, and gold, the oldest crisis asset in human history, did exactly what it is supposed to do. But then something unexpected happened. By March 3rd, spot gold had reversed, falling 3.6% to $5,137 per ounce, a $282 collapse in less than 24 hours, with a war still raging. How does gold crash during a war? That question is the entire story. Here is the mechanism most people do not understand. Think of the global safe haven market like a bus with 2 seats. One seat is gold. The other seat is the US dollar. When fear spikes, money rushes for the bus. Both seats fill up. But then one passenger gets pushed out, and it is almost always gold in the short term. When the Middle East conflict escalated, energy prices surged instantly. Higher oil means higher inflation. Higher inflation forces the Federal Reserve to rethink rate cuts. Traders repriced Fed expectations on the spot. The CME FedWatch tool now shows investors widely expect the Fed to hold rates at their March 18th meeting, possibly beyond that. Higher for longer rates make the dollar stronger. A stronger dollar makes dollar-priced gold more expensive for buyers in every other currency. And when institutions need liquidity fast, they sell what has the most profit, which, after a massive gold run, is gold itself. Bob Haberkorn, senior market strategist at RJO Futures, said it plainly on March 3rd. The move lower in gold was a flight to cash, driven by a strong dollar and rising bond yields. That is reason number 1, dollar competition. When fear is extreme, the dollar and gold both attract capital, but rising yields give the dollar a yield advantage gold can never match. Short term, the dollar wins that fight. Reason number 2, forced selling from equity losses. When the Dow drops 700 points, institutions face margin calls to cover losses in stocks. Portfolio managers sell whatever has gains. Gold, which had been up over $2,200 in a single year, was sitting on enormous unrealized profits. It became the ATM. Reason number 3, inflation repricing. Surging oil from the Strait of Hormuz closure does not just hurt gas prices. It raises shipping costs, food costs, and manufacturing costs globally. Markets are now pricing in a scenario where the Fed cannot cut rates to protect the economy because cutting rates into an oil shock would accelerate inflation. That uncertainty hits gold's investment case hard in the short term, because part of gold's thesis rests on falling real interest rates. Now here is the part nobody in mainstream financial media is explaining properly. While retail investors watched gold drop $282 and panicked, some selling, some frozen, some confused brick, central banks did not blink once. Central banks bought over 1,045 tons of gold in 2024 alone. That is nearly 29% of total global mine production absorbed by sovereign buyers in a single year. They did it again in 2025. They bought 244 tons in just the first quarter of 2025. These buyers are not watching a price chart. They are not checking CNBC. They are executing a structural strategy to move away from the US dollar, and gold is the centerpiece of that strategy. On October 31, 2025, BRICS launched a pilot currency called the unit. It is pegged to 1 gram of gold and backed 40% by physical gold and 60% by BRICS national currencies, designed specifically to settle international trade without touching the US dollar. The BRICS bloc now holds over 6,000 Tons of gold collectively. Russia holds 2,335 tons. China holds 2,298 tons. India holds 879 tons. These are not investors chasing momentum. They are nations building a parallel financial architecture, and gold is the foundation. While retail investors were panicking over a 3.6% single-day drop, sovereign wealth funds and central bank mandates were being quietly executed. The World Gold Council survey data shows 76% of central banks plan to increase their gold holdings further. 75% plan to reduce their dollar exposure. There is a name for what is happening. It is called a structural floor. Even when daily volatility crashes gold, the institutional bid underneath does not disappear. It simply waits for the selling to exhaust itself, and then it absorbs every ounce. The mainstream financial media covered the $282 drop as if gold was breaking down. It was not. It was being shaken out. There is a difference, and understanding that difference is worth thousands of dollars to anyone holding this metal right now. But here is where it gets truly interesting, because what happened in the past reveals exactly what is coming next, and the historical parallel you need to see will completely change how you read this market. Here is part 2 of your script. Go back to January 30th, 2026, a single trading day. Gold futures dropped more than 11% in hours. Spot prices fell close to 10%. It was the steepest single-day fall since the early 1980s. Every retail investor who saw that number panicked, and then gold came back hard. Within days, it had recovered most of the loss and was testing new levels again. Deutsche Bank did not flinch. They kept their $6,000 gold target intact through the entire plunge. Their reasoning was direct. The structural case was stronger than any single headline shock. That January 30th event is the mirror of what happened on March 3, 2026. Same pattern. Violent drop. Retail panic. Institutional silence. Then recovery. The metal experienced its worst two-day decline since 1983, followed by its strongest single-day rebound in over 17 years. That is not a broken market, that is a shakeout. Every time gold has done this, fallen violently on fear, then recovered, the structural buyers were not selling. They were waiting. Understanding that pattern is the single most important thing a gold investor can know right now. Now here is what has not changed, not even slightly. First, central bank buying is still running at 4 times the pre-2022 average. JP Morgan expects about 585 tons of quarterly demand from investors and central banks combined in 2026. That is a structural floor underneath this market every single quarter. Second, the dollar's long-term trend is still weak. The dollar had its biggest 6-month drop in over 50 years during 2025. 1 week of dollar strength driven by a geopolitical shock does not reverse a decade-long structural decline. Third, de-dollarization is accelerating, not slowing. China is actively selling U.S. treasuries and recycling the proceeds into physical gold. Poland, Singapore, Turkey, and others are holding more physical gold and reducing their exposure to fiat currencies. This is not a trend, it is a structural shift unfolding over years. Fourth, real yields are still near historic lows. The moment the Fed signals any rate cut, which Goldman Sachs and Morgan Stanley both expect after June 2026, gold's investment case gets an immediate boost. Now I am going on record. Screenshot this. By September 30th, 2026, spot gold will reach $6,200 per ounce. Here is why that number is not speculation. JP Morgan raised its gold price target to $6,300 per ounce by end of 2026 on February 2nd. Wells Fargo lifted its year-end target to $6,100 to $6,300 an ounce. UBS put its target at $6,200 by September 2026. The Middle East conflict has not been resolved. Oil supply disruption fears are not going away, and the Fed cannot cut rates into an oil shock, which means real yields stay elevated longer, keeping pressure on equities and pushing more institutional capital into gold as the only neutral asset left. The path to $6,200 is not straight, but the destination is clear. Now the scenarios. Scenario 1: the conflict escalates further. Iran does not back down. The Strait of Hormuz remains restricted. Oil pushes above $130. The Fed holds rates through the year. Gold tests the $7,400 level by December 2026. Probability, 30%. Scenario to conflict stabilizes but does not resolve. Ceasefire talks begin. Oil pulls back to $90. The Fed cuts once in September. Gold reaches $6,200 by Q3 and consolidates between $5,800 and $6,400 through year-end. Probability, 55%. Scenario 3 Full de-escalation. Peace talks succeed. Oil crashes. Dollar surges. Gold retreats to $4,800 support and holds. Institutional market treats $4,500 as structural support level. Probability, 15%. Now the practical advice, and this is different depending on who is watching. If you are holding physical gold right now, do not move. You are holding an asset that 3 central banks bought more of this week while you were watching the price drop. Your job is patience, not reaction. If you are actively trading gold with leverage, the volatility is your enemy and your opportunity. The key level to watch right now is $5,100. Gold is currently testing the target zone of $5,292 to $5,249 on the technical chart as of March 5, 2026. A hold above $5,100 confirms the bull structure is intact. If you are sitting in cash waiting for the right time, understand that you are competing against buyers who do not care about the right time. Central banks execute monthly purchase mandates regardless of price. Every month you wait, the structural floor rises under you. If you bought near the $5,595 all-time high on January 29 and are underwater, this is not the moment to sell. Deutsche Bank analysts said the recent sell-off overshot its actual catalysts and that official, institutional, and individual buyers have not likely changed for the worse. You are not wrong. You are early. Now the 4 things you need to watch going forward. Watch the DXY, the US dollar index. If it rolls over below 103, gold has room to run hard. Watch the CME Fed Watch tool for the March 18 Fed decision. Any hint of a dovish pivot accelerates gold's next leg up. Watch COMEX gold inventory levels. When physical drawdowns accelerate, paper prices follow physical, not the other way around. Watch the Strait of Hormuz daily. Oil supply disruption is the single most direct accelerant to gold's safe haven bid right now. 3 types of people are watching this market today. The first type panicked at the $282 drop on March 3rd. They sold. They are now watching gold claw back. They will buy again at a higher price. Which is the most expensive lesson in markets? The second type is frozen. They see the volatility. They see the war. They see the dollar strength. And they are paralyzed waiting for certainty that will never come. The third type understands the mechanism. They watched the drop, checked the central bank data, looked at the structural floor, and made a decision based on information. Not emotion. Which type you are is not fixed. It is a choice you make every single time the price moves. Markets do not destroy wealth. They transfer it. They move it from those who react to those who understand, from those who follow headlines to those who follow the mechanism underneath the headlines. What happened in the last 72 hours was not a gold story. It was a panic story. Gold did exactly what gold does in a crisis. It attracted every frightened dollar on the planet, then shook out every weak hand, and now sits waiting for the next leg up. The question I asked you at the start of this video was, do you understand why gold crashed during a war? Now you do. And that knowledge, the difference between a $282 drop and a buying opportunity, is exactly what separates the people who build wealth from the ones who watch others do it. Like this video, share it with someone who is watching their gold position right now and cannot figure out what to do. Subscribe to Capital Anchor because the next move in this market is coming faster than most people expect, and drop 1 word in the comments right now. Just 1 word that describes how you are feeling about gold today. Let me see where you stand. For Capital Anchor, stay prepared, not surprised. This video is for informational and educational purposes only and does not constitute financial advice.